Hello, and welcome to this tax update brought to you by Tax Essentials for Advisors. This week we can confirm the date of the first budget under the new Chancellor, warn you about a known error with Class 2 national insurance contributions, and consider whether business property relief applied to a business involving serviced offices. The Chancellor has confirmed that this year's autumn budget will be held on the 28th of October. While the announcement doesn't reveal any new tax measures, it does provide certainty over the timetable for what will be the most significant fiscal event of the year. John Healey has stressed that the budget will be delivered within the government's fiscal rules and that maintaining economic credibility remains a priority. At the same time, the government faces growing pressure to fund a range of spending commitments against a backdrop of higher borrowing costs and continued economic uncertainty. For tax advisors, the key point is that the budget countdown has now begun. We can expect a steady stream of consultations, technical announcements, and policy speculation over the coming weeks, before the Chancellor sets out the government's tax plans on the 28th of October. As always, we'll keep you updated as further announcements are made and, of course, we'll provide a full budget analysis once the detail is published. HMRC has identified a problem affecting some self-employed taxpayers completing their self-assessment returns. The issue relates to voluntary Class 2 national insurance contributions. Some taxpayers with profits below the small profits threshold, who had not chosen to pay voluntary Class 2 contributions, found that HMRC's calculation nevertheless included the charge. HMRC has acknowledged the problem and is working to correct the calculations, but in the meantime, advisors should encourage affected clients to check their tax computations carefully before making payment. Although the financial impact will generally be modest, it's a useful reminder that HMRC's online calculations should not simply be accepted without review, particularly where optional elections or voluntary payments are involved. For advisors with self-employed clients, especially those with lower levels of trading profits, it's worth checking recent returns to ensure that voluntary Class 2 national insurance has only been included where the client intended to pay it. The government has issued another reminder that it is making increasing use of third-party information to identify landlords who may not be paying the correct amount of tax. HMRC now receives data from a wide range of sources, including letting agents, local authorities, tenancy deposit schemes, and online property platforms. That information is matched against self-assessment returns to identify cases where rental income may have been omitted or understated. Where discrepancies are identified, landlords may receive one of HMRC's so-called nudge letters, encouraging them to review their affairs and make a voluntary disclosure if necessary. The key message for advisors is that HMRC's data capabilities continue to improve. Rather than relying solely on inquiries or random compliance checks, the department is increasingly using sophisticated data matching to target specific taxpayers. If clients have historic errors in their property income reporting, it is usually far better to correct them voluntarily before HMRC gets in touch. Doing so can reduce penalties and often leads to a smoother resolution than waiting for an enquiry to begin. This case is another reminder of how difficult it is to establish a reasonable excuse for the late payment of tax. The taxpayer received valuable property following the liquidation of a company and argued that he couldn't pay the resulting capital gains tax until he had restructured the ownership of the properties and arranged borrowing against them. The tribunal accepted that this was the route he ultimately took to raise the funds. However, it found there was insufficient evidence that he couldn't have raised the money by another method, or that the delays in restructuring the properties were genuinely outside his control. The legislation is quite clear that a shortage of funds is not, by itself, a reasonable excuse. The taxpayer must show that the lack of funds resulted from events outside their control. For advisors, it's another useful authority confirming that financial hardship arguments remain difficult to sustain unless supported by compelling evidence. This Upper Tribunal decision will be of particular interest to advisors dealing with business property relief. The case concerned a company operating serviced offices from a commercial building. The executors argued that the business went well beyond passive property investment because it provided a wide range of services to occupiers. The Upper Tribunal accepted that some elements of the first-tier tribunal's reasoning were incorrect, particularly its treatment of utilities such as heating and electricity, However, having reconsidered the case, it reached exactly the same conclusion. The tribunal held that, viewed as a whole, the essential nature of the business remained the provision of office accommodation. The additional services, while valuable, did not alter the fundamental character of the business as one of making or holding investments. For advisors, this is an important reminder of the investment business exclusion for business property relief, and underlines how difficult it can be for any property businesses to qualify for relief, even where a significant level of additional services is provided.
Thanks for that, Andy. Just a reminder that our next webinar will take place on Wednesday, the 26th of August at 1 p.m. and will feature Jack Bonehill of the Tax Professionals podcast talking to Andy and Rachel about tax-free benefits. This will include various key points about the planning opportunities and common traps to look for when advising on this area. The link to register is showing below. Hope to see you on the day. Bye for now.